Silver's next major target is $175 per ounce. This chart pattern for gold using Fibonacci extension is actually pointing to the downside target for this is pointing to about $39.40 per ounce. If gold can get traction and start to run, then it's heading to about 8,800. If gold continues to pull back further and sells off, the chart is pointing to about 3,600 on the downside. It's going to 8,800 at some point, but it could also go down to 3,600 first. Doesn't matter what the news is. Price does two things. It goes up or it goes down, right? And there's always going to be a different time. This time is different. It's always different. Psychology does the same thing. People chase things up and then they panic out. It doesn't matter what it is. We've seen these parabolic spikes before. And for this parabolic spike, we're right up here. And it could do the same thing. It could pull back. Assets typically move in a way that you least expect. Like if you're an emotional trader following the news, the price action usually doesn't make much sense. Usually you're like always on the opposite side news-wise. Right now, I think we're going to see gold pull back.
If you look at gold, Chris, gold is still probably viewed somehow as a defensive asset. But while we've seen stock markets going higher, gold also did really well in the past 12 months and even longer. So how is gold looking right now from the technical side?
Yeah, so gold has mixed signals. So when we look at it from a long-term standpoint, it's got this beautiful rally up here, and we could argue it's building a bull flag chart pattern that points to another huge move, another big move from here. If this is the low in gold that we saw back in March, if gold can get traction and start to run, then it's heading to about 8,800. Now, if gold continues to pull back further and sells off, the chart is pointing to about 3,600 on the downside. And so right now, gold has a long term, when we look at these moving averages, this green 150-day moving average, that is sloping up, price is above it. So it's saying, hey, gold is still in a bull market. But the short-term price action, when we zoom in, it really is making a series of lower highs, lower lows. All of the shorter term moving averages are sloping down. And so the short term trend is down. And so when you have these kind of like mixed signals, right, it's best to just wait and see.
Gold just flashed a classic late cycle warning. Long-term momentum is alive while short-term money quietly exits. As Chris Vermeulen points out here, gold's technical structure still allows an $8,800 target. Yet traders are ignoring the equally real possibility of a brutal drop toward $3,600 first. That contradiction matters because institutional capital typically unloads risk during periods retail investors call safe haven rallies. For physical metal holders, this is the dangerous zone where emotional conviction can erase years of disciplined gains. Next, Chris Vermeulen exposes why declining momentum inside a bull market often signals institutional distribution before the public notices.
So, it's going to 8,800 at some point, but it could also go down to 3,600 first. And I want to wait to see which way it actually wants to go. I'm not looking to benefit from falling gold. I would like to see gold fall down to about 3,600. I think that'll be an amazing opportunity to buy physical metals, hold for the long run, and then go see it run 150%, fairly quickly after that. But right now, gold and silver and even miners, they all have the same chart pattern. They have mixed signals, and right now we just have to let the charts figure out which way they want to go and then take action once a new uptrend is confirmed, or wait till it hits the significant pivot low that the chart is pointing to the downside.
Yes, and could we look at silver? Would silver look quite similar, Chris?
Yeah, so silver, I'll just pull the silver chart. So if we take a look at silver, same type of thing. The long-term trend is up, price is above it. It is making a series of lower highs and lower lows. And the chart of silver, now if same scenario, if this low for silver holds and we start to see silver start to rally and start to move higher, silver's next major target is $175 per ounce. Now, this chart pattern for gold using Fibonacci extension is actually pointing to the downside target for this is pointing to about $39.40 per ounce. So there's a pretty good pullback potential still, just like gold, that we could see silver unwind and sell off in a pretty big way. And so again, long-term trend up, short-term trend down. We have mixed signals. There's big opportunities, to the downside, there's big opportunities to the upside. We just need to wait for a confirmed trend and then take action once that happens. Like right now, getting into gold and silver, I feel is a little bit more of a coin toss. It could go either way, and I don't really like to play that game. I want to try and put it when it's something is extremely undervalued at a key target on the downside, or I don't mind paying a higher price, but I want to buy it when it's running and it's going to take off for hopefully several months, if not several years. So right now, we just have to wait. Silver has got lots of upside. It's got lots of downside potential. It just doesn't know which way it wants to go. And we can actually see that on this chart when we look at the volume. I mean, there's very, very little volume. It went from everybody wanting to get in and being excited, huge volume, to now everybody's like, I don't want to touch it. I'm down, 30, 40% from where a lot of people purchased it right near the peak, and they're down fairly substantially. So people are just trying to figure out what to do with that as well.
Right. And if you look at the big picture, even in gold and silver,
silver volume has collapsed right as bullish headlines became loudest. And historically, the timing rarely ends well for impatient investors. As Chris Vermeulen points out here, silver could still explode toward $175. But weakening participation and lower highs suggest institutions are withholding conviction while retail keeps averaging in emotionally. That divergence between price optimism and participation matters because the biggest commodity reversals usually begin during periods of fading volume, not panic headlines. For mining investors, the next 60 days could determine whether this becomes accumulation or a devastating liquidity trap. Next, Chris Vermeulen reveals why historical silver rallies almost always included a brutal shakeout phase first.
These pullbacks would be absolutely normal, right? We have seen them in the 70s, in 2000, so that would not be something out of the usual, right?
Right. Yeah. And I think that's what I think a lot of people lose sight of. So this is silver, the monthly chart going back into the 70s. We had a huge parabolic spike. It doesn't matter what the news is. Price does two things. It goes up or it goes down, right? And there's always going to be a different time. This time is different. It's always different. But psychology does the same thing. People chase things up and then they panic out. It doesn't matter what it is. We've seen these parabolic spikes before. And, for this parabolic spike, we're right up here at $74. The chart is still pointing for us to come right back down to about 40, which will wipe out most of the spike. That is perfectly normal. In fact, it could go even lower than that, although people don't want to hear that. But that is typical price action. And if we look at what gold has done in the past, gold has done, let me just clean this chart. Well, let's just get rid of some of these. But gold has had these giant parabolic spikes, and then it comes all the way back down, and then it flounders for years. And then it went for another parabolic spike, and then it sold off. And it took roughly, what is this, 11? It took roughly 12, 13 years to break out and start this run again.
If silver retraces toward $40, most late cycle buyers won't lose confidence first. They'll lose liquidity. As Chris Vermeulen points out here, the current setup mirrors the parabolic blow-offs of the 1970s and early 2000s, where metals erased huge portions of their gains before recovering years later. That's the part mainstream precious metals promoters rarely emphasize because buy and hold forever sounds safer than discussing decade-long stagnation cycles. For retirement-focused investors, understanding normal historical drawdowns may matter more than chasing upside targets during euphoric sentiment. Next, Chris Vermeulen unravels why every major precious metals mania required a painful psychological reset before the real breakout began.
And it could do the same thing. It could pull back. Assets typically move in a way that you least expect. Like if you're an emotional trader following the news, the price action usually doesn't make much sense. Usually you're always on the opposite side news-wise. And right now, I think we're going to see eventually gold pull back. We've got the chart pulling back to about 3,600, and it could flounder here for several years. And so that's what people just need to understand. This is part of a huge cycle. Gold has these 10, 15-year cycles, and we've just had one of these peaks, and now we just need to let it sort itself out, and eventually it'll turn back up, and then, then you can be excited about it again. But right now, I'm not very excited about gold.
Yes, and this spike that we're seeing here, Chris, it looks like a huge parabolic move. But if you look at this move in percentage-wise, it's probably actually lesser than during the previous runs, right?
Yeah, let's take a look. I'm not sure. So we've got this previous low from early 2000 to the peak. It was about 600. And then we had the market reset, and then it put a low in, and now it's rallied up, and it's only 400 and change versus 600 and change. So I mean, it was definitely a nice big move, but this is what we've seen.
Wall Street keeps calling gold the safe trade, yet historically its biggest rallies were followed by years of dead money. As Chris Vermeulen points out here, this current run is actually smaller than previous historic gold cycles, which means the emotional excess investors feel today may still be early stage psychology, not final capitulation. That breaks the popular narrative that gold only rises during instability without violent resets in between. For investors overexposed to metals, a multi-year sideways grind could quietly destroy purchasing power through opportunity cost alone. Next, Chris Vermeulen exposes why percentage comparisons to prior gold cycles completely change the current bullish narrative.
I don't know what the percentage was over here. Let's take a look at this one from the 70s. That one was about 700 and almost 800. So yeah, I mean, these moves are actually very, very similar. In fact, the one in gold so far is still is the smallest out of them all. So it'll be interesting to see where this unfolds. And let's just actually, out of curiosity's sake, the Fibonacci target for gold is 8,800. So let's just see what percentage-wise that would be. If we were to pull this up, where does that put us? So if gold is to find traction where it is, say gold has one more huge push, say this was the warm-up run, it stabilizes, and then it really goes explosive because something falls apart in the world, then we would actually get right up into that 600-700 sweet spot. So that's what we need to see. And that's what is exciting about gold. Is the gold chart I find is very, very accurate. The thing is, it just takes years for these patterns to set up. And right now we're just waiting to see, like, is gold going to start this next run and take off and be another huge opportunity to almost double our money, or is it going to correct deeper and give us an opportunity to start stacking at a lower price for this pending run going forward? And so, it's exciting. The precious metal space, very exciting, but it just had that euphoric move, and now it could be dormant for a long time. So
central banks continue accumulating gold, while momentum traders quietly reduce exposure. And that split usually signals transition, not stability. As Chris Vermeulen points out here, if gold eventually reaches the projected $8,800 Fibonacci extension, it would align almost perfectly with the explosive percentage gains seen during prior historic monetary stress cycles. But institutions rarely buy aggressively after euphoric retail spikes unless they expect deeper systemic instability ahead. For long-term savers, this means the real opportunity may emerge after a demoralizing correction, not during today's emotionally charged optimism. Next, Chris Vermeulen reveals why dormant periods in gold often precede the most explosive wealth transfer phases in financial history.
We just have to kind of be patient, find other things to invest in that is moving in favor until gold sets up a key opportunity.
Yes, definitely. And you would see mining stocks as a leverage play on the metals, right? So once we find out which direction it goes, they will just offer bigger leverage than the actual metal.
Yeah, they should. In theory, they should. Doesn't always mean they will, but the mining space, I think, will be a amazing opportunity. So for example, if gold and silver are to pull down to those lower targets, like 30,600 for gold, say $40 an ounce for silver, we'll probably see the miners coming all the way down back to the 60-50 mark, somewhere down in here. And once gold and silver have pulled back to those levels, I think the more exciting play isn't actually going to be physical metals, although I think everybody should have some physical metals. I think the miners are going to be a very, very powerful play. I think that is where they're going to go absolutely ballistic. And if we see gold and silver and miners pull down to this level, it probably also means the economy's just gone through a bit of a recession. The stock market has probably also sold off dramatically, which is what we want. It's a full cleansing event. And then when you buy stuff after that, it's the key is like, where are the best pockets? Fundamentally, you want to move into the strongest fundamentals in an oversold condition.
Mining stocks don't usually become generational opportunities during excitement. They become generational opportunities during economic exhaustion. As Chris Vermeulen points out here, if gold and silver collapse toward deeper technical targets, miners could experience a final washout before explosive upside returns. That's the phase institutional capital quietly waits for, while retail investors panic out after years of underperformance and emotional fatigue. For long-term wealth preservation, the real risk isn't volatility. It's deploying capital before the cleansing phase finishes. Next, Chris Vermeulen exposes why recession-driven liquidations often create the best mining entry points in decades.
I think miners will be screaming by. I think uranium stuff. There's a lot of different pockets I think that are going to be great. But usually if we get this set up where gold, silver, and miners pull back to these levels, the whole broad market is sold off. Probably unemployment rates skyrocketing, and investors are really suffering from falling stock market. So we just have to let the market figure itself out. Everybody always wants answers and they want stuff to happen right now, but you do have to step back, just like you're saying. Let's look at these bigger pictures. Again, this is the monthly chart, and it's pointing to we have potentially a year in the precious metal space just for maybe it to get its footing to figure out what it's going to do here. So I think people need to relax. Don't get too thinking gold's going to move at any point. I think if it does move sooner, that'll be great, but I think people need to focus on what is moving, what has consistency. And right now it's the stock market. I like the S&P 500, the NASDAQ, we're long both of those. And if you look at the markets through the lens, like how I look, like this is the S&P 500 daily chart on the left. When you look at the stock market through a technical lens, through price trend, and then you look at it through volume flows, where's money flowing between about 12 or so different asset classes, and cycles and sentiment.
Markets usually look strongest right before investors stop respecting risk entirely, and that shift is already visible in momentum flows. As Chris Vermeulen points out here, capital is currently rotating into the S&P 500 and Nasdaq, while precious metals stall in a holding pattern that could last another year. That timing matters because institutional money rarely waits emotionally for dormant sectors to recover. It hunts momentum first and value later. For retirees overloaded in metals, this divergence can quietly drain portfolio performance while inflation keeps compounding underneath. Next, Chris Vermeulen reveals why patience in one cycle often requires abandoning emotional attachment to another.
It tells you, should you own stocks or should you get out of stocks? And so we've seen the market have this correction with the Strait of Hormuz. The money flows were telling us before it really even started that something was coming, and we stepped aside. We got back in recently. The market bounced and it turned into an uptrend. And it's the same with the NASDAQ. The NASDAQ has taken off. We're long a 2X ETF. It's up about 23%. And the markets are really, that clear. If you can filter out the noise, the news, the fundamentals, and just focus on money flows. This is something I was talking with somebody the other day. They're like, how do you factor in the news and all this stuff? I'm like, well, believe it or not, investors in the price is already factoring in the news that's about to come out in most cases, unless it's surprise news, like a tweet or like some type of social post that's instant. But the market and the money flows, there's big, smart money that knows what's going on. I have a way in order to track those that tells us, hey, that money is moving out. We should probably follow them. Let's ride their coattails. And so that's what I follow, is the coattails of the big players hidden kind of behind the market. And then I also confirm it with the trend. Just because they're buying doesn't mean I want to get in yet. I want to make sure price has confirmed and is in this big rally mode. So that's the big kind of picture look that people need to focus on, is focusing on the money flows and the trend and where the money is flowing, right?
The public still believes headlines move markets, yet institutional money positioning often shifts weeks before the narrative changes. As Chris Vermeulen points out here, tracking money flows correctly allowed traders to step aside before the correction and re-enter as momentum returned to the NASDAQ. That directly contradicts the mainstream belief that reacting to economic news protects portfolios, because by the time media confirms danger, smart money has usually already repositioned. For older investors managing retirement capital, delayed reactions can become catastrophic during volatile cycles. Next, Chris Vermeulen unravels how institutional trend confirmation exposes moves long before financial television catches up.
People they fall in love with one sector and then it goes dormant for 10 years. Like the precious metals in the miner space was dormant forever. So you have to be able to step away from what you like and go find something else. And to me, I don't really like anything. I like whatever at the time is moving. And so it's that I think is the key, is to not build a relationship, not build a straight focus with just one asset or commodity, but to just like whatever is most favorable and most has the highest probability of giving you opportunities or winning trades.
Is there anything else? Would there be any other markets that you are looking at that you believe are attractive or maybe important? Maybe things like copper or anything?
The only other one that I do like to keep an eye on is the dollar chart. And that's simply because the dollar here, I think, is trying to carve out a bottom. So we've got this potential rounding formation for the dollar. If it starts to break out of this base to the upside, that is going to tell us that there's a lot of trouble going on around the world. We're going to see things slowing down. So if the dollar starts to break down and starts to make new lows, it's going to be actually, it'll be bullish for stocks. I think that means the market is running away. It's got a euphoric move. Everybody's just piling into stocks. There is no risk.
The dollar quietly building a bottom, while investors pile into risk assets, is the kind of divergence that usually appears before broader stress emerges. As Chris Vermeulen points out here, sectors can stay dormant for a decade, while institutional capital relentlessly chases whichever market currently controls momentum and liquidity. That reality destroys the emotional buy forever narrative many precious metals investors were sold after the last inflation scare. For portfolio protection, flexibility matters more than ideological loyalty when macro conditions shift underneath the market. Next, Chris Vermeulen reveals why a strengthening dollar could expose hidden fragility across global equities and commodities simultaneously.
Nobody's afraid of anything. They're just moving in. So I want to keep my eye on the dollar. And if the dollar can start to close above this 101 area and start to hold up above this blue line, if it does that, then I do believe we're going to be starting into some type of global kind of recession of some sort. But until it does, I mean, again, all these big patterns and all these different asset classes, they're all neutral right now. They're all trying to figure out what they're doing, other than the stock market, which is still up. You should be long stocks. It's the only asset that I like right now.
The market's biggest danger signal right now may be the complete absence of fear itself. As Chris Vermeulen points out here, if the dollar breaks decisively above the 101 level, it could signal global recession pressure even while stocks continue rallying short term. That contradiction matters because central banks publicly promote economic resilience while currency strength historically tightens financial conditions beneath the surface. For investors chasing euphoric equity momentum, the real threat is getting trapped in risk assets just as liquidity conditions quietly reverse.